We need to talk about investing in a world of coronavirus because old Smugface over here was feeling very clever on budget day because his money was processed into RA, into his retirement annuity, and was feeling very good that the budget was better than expected and markets were stable on budget day after a bit of a sell-off on the day before. And then Thursday and Friday came whack, whack, whack. And then with the recovery on Monday, then whack, whack, we've been whacked again. And it's just like, suddenly you don't feel so clever anymore.
No, it feels like you're suffering from whiplash, I guess, if you're watching market.
Whiplash is a good one, yeah.
In big directions. I think the interesting thing about something like this is, I've been speaking to a few investors in the last few days, and just after the sort of whiplash started, and it's their psychology is fascinating. Especially private investors, people that are not managing money on behalf of others, and they are most similar to what happened in 2008. It's the best sort of comparison I can find. Is South Africans are interesting. We look at a situation like that. It's something we have no control over. Very much in the purest form, an external, unplanned event, very much like 2008. And we look at it and we say, okay, well, we can deal with volatility. There's nothing we can do actually much in this situation. The event has actually already happened from a market point of view. And, let's bat it out. Let's just, batten on the hatches, see what's going to happen and carry on. And I think that's a really pragmatic attitude. I think, interesting to watch this because we live through this. Our market is volatile, but I don't think it's nearly as volatile, for example, as the US market, moving up and down 5% in a day.
I haven't seen this sort of activity since 2008. I mean, this is proper fear stuff. There's even a fear index, and I'm sure the fear index is even scared.
It is, yeah, exactly, yeah, it's frozen. And so what's interesting for us is I think we with our circumstances as a country and our history in the last sort of 10, 15 years, we look at this and we don't panic on the same scale as the Americans and the Europeans are doing. And I think that gives us quite an advantage actually when we start making, or making investment decisions, or for example, not making investment decisions, which is a decision all in its own. And I think that's the situation we're now, is that we look at this and we say, well, these people in the developed world, they don't deal with a heck of a lot of volatility in their personal circumstances like we do on a daily basis. So when they have a threat of a virus that might kill 1 to 2% of the people that get infected, it sounds like a heck of a lot of people, but actually, I mean, that's quite small. I mean, my colleague said to me, why are you nervous about driving to the studio and sitting in the studio? Your chances of getting killed in a car accident are probably much higher on the way to the studio than getting sick from something in the studio. And that's a good point. We understand risk in a totally different way when it's personal risk.
Oh, absolutely. I mean, when social media today was welcoming coronavirus in, saying, we hope you survive, basically. This is a tough place, Corona. Are you sure you picked the right fight? Whereas in other parts of the world, people are battening down the hatches and going to supermarkets and buying bottles of water and behaving like it's South Africa in 1994.
Yeah, and what's interesting is, anecdotal evidence, talking to people who've flown into South Africa in the last few days, that there's really heavy scanning, on the plane of every single passenger, and people are being checked very correctly, and so that's quite interesting. And I think there's a South African living, I can't remember his name now, in the UK, and he was saying he was screened really heavily flying into South Africa. On the way back to Heathrow, nothing. No screening. You went straight through. So that's interesting. I think, whether we prepared on our borders on every single, entry point and, when you swim across the Crocodile River, whatever it is, what's the one between here and Zim, you're probably not getting screened there. But the point is, we'll deal with this. And from an investment point of view, we can look through this stuff.
It was really funny. I mean, funny, not funny, haha, but funny, strange to go through OR Tambo this week, and people wearing rubber gloves and masks, but a lot of people getting really fed up with the face masks, so wearing them on their heads like hats. It was walking around with like slightly oversized yarmulke, running around the airport, and you go, hold on a second, if we are going to be serious about this, I mean, the airports company clearly is looking after people and is wanted to create the impression of having control. But that's the first moment I sounded, my heart rate went up, going, okay. It's a bit like Philip, it's here.
It's arrived.
Yeah, it's arriving. We know it's coming.
So I think, I think when I look at this, I always like to look at the world the way, our favorite, scenario planner looks at the world, Clem Santa. And it's interesting because he's really,
we had him on the show on Friday. If you missed Clem Santa on this, it's worth picking up the podcast on it, because he said this was one of the flags, and he talks about flags about all kinds of issues, but a pandemic is a flag that he raised many years ago in one of his Fox books.
And I think he's now done, he's looked at this and he's put it into, so if that was the podcast from Friday, then and he's talking about this, I think one of the scenarios is that actually this is much ado about nothing, and so not saying that the virus doesn't hit South Africa, not saying that quite a few people get sick, but actually saying that it doesn't necessarily have a long-term structural impact on what goes on in the South African economy or even the global economy. And I think that's really a way to look at this. It was interesting to me, for example, hearing Berkshire Hathaway, which Warren Buffett's company, buying up additional shares of Delta Airline. Now, I mean, you would imagine listed airlines around the world are being, and they are, being hit in this.
Well, I mean, a little airline, it's quite a big airline in one of Europe's biggest sort of regional airlines, Flybe, and they fly smaller aircraft, a bit like Airlink does. It went bust today in the UK. It was already on its knees. It already had problems, but just with a sudden drop off in air travel, it died today. It is a victim of coronavirus.
Their last straw.
Yeah.
And so I think, if someone like Warren Buffett, is looking at this and saying, well, he's always careful to deploy his cash and he doesn't do that quickly. And he's looking at this kind of a situation, and probably not him, because it's actually in the scale of things, such a small amount of money that they've deployed into this. But if they are, then it tells you something. And it's a view that I'm starting to share, which is this will have a structural change to the economy, for example, in things like supply chains. I think that this has woken the world up to the fact that we can't all have.
You can't put your factory just in one place, which is China. Yes.
Well, yeah, or that your entire supply chain, at some point, the link runs through China. So you might not have all your factories there, etc. But for example, if you're a big South African manufacturer of trucks, which we have one in South Africa, and you have certain parts which are made at $1 a piece in China, and your truck doesn't run without that $1 a piece, and now China's closed down, that's going to force a rethink of supply chains. And I think that's quite interesting, but I don't think that means it's a structural damage to the economy long term, and we're at the end of time now. I think it's just a particular issue for now that we're going to have to look at, but I'm not saying end of the world now, and investments as we know it are over.
I found a fabulous graph today that was posted by Mduduzi Lutuli, who, if you don't follow him on Twitter, you should. At Trust Fund Zulu. He goes by the name of Trust Fund Zulu. Mduduzi Lutuli is a fund manager. He manages other people's money. Posted a graph today, and I want to take you through some of that graph and tell you what the end result is of that graph in a minute or two. Questions for Warren? Comments to make? 011 883 0702 021 446 056.
The Money Show. Personal finance.
There are often very good reasons to panic in markets. There are often very good reasons why people feel it is an opportune time to sell out of their investments and turn into cash and put their money into a safe bank account. So let me give you an example. Or 100 examples quickly. In March 2009, this is the time of the global financial crisis, 663,000 jobs were lost in March in the US economy. That's huge. I mean, they've been creating jobs since then, but you didn't know that was going to happen. Chrysler and General Motors very soon after that filed for bankruptcy. Then there was the BP oil spill. Then there was a flash crash on US markets. Then the most powerful earthquake ever hit. The S&P downgraded US debt in September 2011. The fiscal cliff in the United States. Remember those discussions during the Obama years in November, December 2012. Cyprus then defaulted on its debt. There was a US government shutdown in December 2013. The Ebola virus then hit in about December 2014, and people panicked, and there was a big dip in markets back then. There was the US election for Donald Trump, of course, and there the futures fell about 5% in a day. And then there was Brexit, and that caused markets to go backwards. Then the volatility index at about December 2017 hit massive highs. The Dow saw its biggest points decline ever in March 2018 of nearly 1,200 points. That was then the biggest decline ever. The S&P 500 entered a bear market in December 2018. Remember that? Everybody was thinking that this was the end. And then we have more recently, we've seen emergency funding coming into markets. We've seen trade wars. We've seen the inversion of the yield curve. So US debt dropped to below 1%, and it's done it again. And now recently we've seen the coronavirus, and that's a big drop-off. It's very similar to the drop-off that we saw in December 2018, a very sharp pullback in the S&P 500. And Warren Ingram, I mean, each one of those was an individual reason why you would not stay invested in markets, because it's scary. And I mean, markets are volatile and frightening. But since March 2009 to about last week, how much had the S&P 500 gone up in 11, 12 years?
I actually don't know, but I mean, it must be well over 12% a year, somewhere around there.
But okay, fine. Don't ask me to do maths, but it's up 431%. Lots. So the S&P, all the value of all of the companies on the S&P 500, America's 500 biggest companies are 4 times more valuable today than they were in 2009. And had you sat on the sidelines at any one of those moments, you would have sat in cash and you would have grown at a much lower rate, certainly in the US where interest rates are at 1 or 2%, than by staying invested in stock markets. And maybe that's the coronavirus lesson, or maybe this is the thing that leads to the end of the world. I don't know. But every single crisis seems like a huge crisis in its moment.
Well, and I think that's the intellect that you need to apply to markets. Is sometimes, as you said, there's a good reason to be cautious. I think there's probably never really a good time to panic when it comes to markets. I think, lions and rhinos are often a good reason to panic, but not necessarily markets. And to me, this is one. This is the time when you should be saying, if there is no structural change to the way the world works, the way investment markets work, the way the economy works, then this is really one of those cliched buying opportunities. This isn't a time to be super fearful. And I think the core sort of reason, if I look at this, is we've already seen the US Federal Reserve doing what they can to help underpin the markets. In other words, they've cut interest rates. They're putting a lot of liquidity back in. I think it's probably now going to be, not necessarily in total, but individual efforts on the same scale as 2008. We absolutely know the Chinese government will be doing something to stimulate their economy as well, and they'll take big steps. So in my view, I look at this and I say, well, once we've got a grip of the real impact of coronavirus, and maybe it's not as big as what the market initial reaction is telling us it's going to be, then the stimulus that's coming into the economy or to the global financial markets will unlock a totally different approach. In other words, people will look at that and say, well, now money's a lot cheaper for us to borrow and to put back into shares. Shares are a lot cheaper than they were. Everyone was fairly fearful of what was going on in the US stock market. And all of a sudden, there's been a bit of a shakeout. So maybe now they look at it and they say, well, now's the time to pile back in again, because yes, we don't want to buy government bonds in America. We certainly don't want to buy them in Europe, and we don't want to park our cash anywhere. Gold looks a bit expensive, and maybe the stock market is the place to go. And to me, I think that's kind of the signal here. I'm not saying necessarily that you pile in right now and sort of mortgage your house and put everything in there, but definitely the decision to sell shares in an environment like this, I think, is a terrible one. And certainly if you've been accumulating cash for some reason, then to start deploying that cash, I think is that's actually a great call. Gutsy call, but actually quite a logical, rational decision, and not one that you base on intuition, but sound reasoning.
And you've got to believe that markets do go up over time. And history shows us that markets go up over time until you start looking at graphs of the JSE of the last 5 years, and then you start believing that story. And that's the problem, is that we look at global markets, we take our own biases living in South Africa, and we know the multitude of problems that exist here. And then we say, but we can't put it into the JSE because it's just done nothing for 5 years. So we're going to put it into global markets, which are up 4 or 5 times in 10 years. That's not a smart decision either.
unless the froth has been taken out of global markets as a starting point. So in other words, that extra bit of overpricing is now done. And just to give you an idea, I was looking at the valuations of technology companies just before this all this fell apart, and their average price earnings ratio was around about 30. Quite high, but at the same time, I mean, they are growing their profits very well. There are actually, a lot of them are paying dividends. There are about 34 of the big tech companies that actually pay dividends. And that value is not nearly as high as it was in the year 2000, just before the crash. That was around 43, the PE ratio of the tech companies, and very few of them were actually even making any money.
And that's the difference. Then, these were a bunch of unicorns without horns. They were horses. They were donkeys, actually. And
a business plan, just really.
Yeah, and they were a lovely idea. This new internet thing's going to be big one day. We just don't know how to make money out of it, so let's list a whole bunch of stuff that doesn't make money. The survivors of that and their progeny are now massive real world digital businesses.
Yeah, and I think that's the point in a situation like this is, something like Microsoft. It's very hard to say that Microsoft is, is just a business plan or a tech thing that's just going to be taken out tomorrow. I mean, many big businesses right now and small businesses can't really function without Microsoft. It's that integral to their businesses right now. And that tells you that if its share price has gone down a bit and it's been paying dividends and it's extremely profitable, then when the share price goes down, maybe that's a time to buy. It's not the time to sell. Coming to the JSE, if it's somewhere around that 52,000, nearly 53,000 level, and there are some good quality South African businesses that do operate globally, that's a good business case to follow, again, because their share prices have been knocked through no doing of their own. And I think it's a time to watch.
And then a signal sent, and I haven't seen the Reserve Bank governor do this before, and maybe I've not looked this hard before, but he gave a speech at the University of the Free State, I think yesterday, and he's talking about the fact that South Africa needs structural reform. He always says that. He gets quite cross about the fact that it's so slow, and that we're dragging our feet on this because we need to restructure the way the economy works. But he always says monetary policy is not a tool that we can use for sustainable fixes in the economy. You've got to fix the economy in order for it to work better. But here he says something quite interesting. He says, we can take the edge off with the interest rate tool, provided we have lower inflation, which we do, and if country risk comes down, which, depending on the discussions that government has with trade unions over the public sector wage bill, we can keep rates low and maybe go lower. I mean, this is a Reserve Bank governor giving a signal like I've not seen him give in a long time.
Well, let's give that a context. At the moment, interest rates in South Africa on South African bonds are out of the biggest economies in the world. Interest rates are the highest in the world for real interest rates. In other words, take the interest rate of the government, of the bond market, subtract the inflation rate. We sit in the place where you earn the highest real interest rate on your money anywhere in the world.
And there's a reason for that. It's a scary place to put your money if you're a Johnny foreigner who's looking for a yield.
Well, you say that, but there are companies that are paying countries that are paying lower interest rates that have been downgraded to junk that look way more scary than we do. Their economies are far less developed, etc., etc. So if you're looking at this and you're a global investor, and the moment this uncertainty is over, and now you've been given a lot more money by your government's Federal Reserve, etc., etc., you're going to be saying to yourself, well, hang on, I can get myself a really nice yield on my money there. That's a signal. And I think the Reserve Bank has scope to cut interest rates by a heck of a lot before we become uncompetitive on interest rates. So I think that's a great signal. And I mean, to me, that's nice for us as South Africans paying bonds, for example, paying mortgages. But for the rest, this is still a great place for people to get real good growth on their cash.
So if I can summarize the last 20 minutes of discussion, don't panic, be lekker.
Don't send your money out of the country at 15.30 or whatever it is, or 15.60 to the dollar. Now is not the time. Wait and be patient. This pendulum swings back.